welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about, have you missed the boat with Christchurch? Has the opportunity gone? Now, here's the thing. We've been banging on about Christchurch being undervalued for a long time on this show. And I definitely think people have got the message with that. But what we're starting to see now is that the opportunity is definitely closing, if not already closed in some instances.
And I think that the challenge at the moment is that we've bleated on for so long about the undervalued position of Christchurch that we're seeing investors go out there and buy properties which will be an okay rental but aren't good investments. And when you run the numbers, they just don't work. But they're so desperate to get an undervalued property that they're prepared to pay too high a price to get into that market.
And so what we're going to do in today's episode is we're going to talk about the Christchurch market, how it's changed, and we're going to give you some examples of properties that were selling a year ago that were fantastic investments, and then what's out of the market today which perhaps isn't as much. But what I want to do first of all is talk about the last 12 months in Christchurch, because values there, according to the Ryan's House Price Index, have increased about 26.1%. Now, nationwide, property prices have increased about 26.7%. So they're pretty comparable. Now, the thing is, I remember 12 months ago, 24 months ago, Andrew, when we were talking about this on this podcast, so many people said, Christchurch is fundamentally different. You're not going to get that same growth. And putting those two things there and saying, actually, it's got just as much growth as the rest of the country, and that growth has been 26% or just north of 26%, that should shatter that notion that Christchurch is somehow fundamentally different from the rest of the country just because it's had a lot of building.
And it's at that point that I want to say my favourite phrase, I told you so.
Well, let's talk about why you think investors may have missed the boat.
So the challenge, as I say, at the moment is that every day we are seeing investors come in with a property to kind of put together or put into their portfolio, and the numbers, again, might look like an okay property compared to, say, an Auckland or a Wellington property in terms of what you're getting for value for money. But because the rentals are nowhere near at the levels of Auckland or Wellington, and the rental market's been relatively flat, the cost of holding on to these properties is so expensive that it makes it not worth it when you compare it to an alternative investment and factor in all of the numbers, which is why it's really important that you use a tool like our return on investment calculator to actually assess the whole deal, not just the price.
So let's get into this, because what I want to specifically show you is the prices that developers are asking for their properties. And what we can see is that the prices that developers are asking for have increased at a much faster rate than the broader market. So 11 months ago, God, I should have bought one of these. Hayward Terrace in Richmond, Christchurch, 2-bed, 1-bath, 8 units within that development, was selling for $449. That was July 2020, so 11 months ago, not even a year ago. We're selling for just under $450, and that was renting out for $420 a week in that instance. So reasonable yield, between 4.5% to 5%. Decent yield, higher than what we'd expect in Auckland, but perhaps some lower growth because of the specific area.
And actually, these were, I've actually been through these, and I don't go physically to many sites, whether or not I own it or otherwise, but I've actually been to these, and this was, I think, a Brooksfield development from memory. So it was a really nice finish, quite impressive. That was actually one of the earlier developments. Really impressed with the overall finish.
Now, looking at a new project by that developer in today's market, Ruskin Street in Addington. Now, admittedly, this is 2-bed plus a study and 1.5 bathrooms. So the difference is you've got an extra toilet downstairs and there's an extra little study nook upstairs. But broadly speaking, pretty similar. This development's got 3 units within it. It's selling for $649, so $200K more. Now, the reason that this is a bit of an issue for me is that the rental assessment, and I actually think this rental assessment is pretty generous if I'm really honest, is $470 per week. Although, of course, the properties are not right next to each other and there are some small differences here, the price increase across these two developments is there's a 44.5% difference in the price that the developer's wanting to charge, but the broad market has only increased by about 26%. So, developer prices have increased 60% faster in some instances, like this one, compared to the broad open market.
And I actually think a big part of this has happened post-government announcements. So now that there is a tax incentive to buy new, what you're finding is a lot of developers are in such demand for their projects, so they're just increasing the price at whatever the market will tolerate. And the market, because of a lack of supply, is tolerating a lot.
And just before Andrew takes you through the ROI across these two properties, I just want to point out the gross yield here. So the first development we just talked to you about had a 4.9% gross yield, which pretty good compared to what you might be able to get elsewhere around the country. This Ruskin Street development, the second one we talked about, that was selling for 649. The gross yield on that is 3.8%. So it's decreased by about 25 odd percent. So pretty significant. Now walk us through the return on investment here, Andrew.
So actually, I've done our full return on investment calculator, version 2.8.1, which is our latest and greatest. If you watched the last week's webinar, Know Your Numbers with Nickel or whatever it was called, this was the one we used. And actually what we'll do is we'll drop a link in the show notes to download the return on investment calculator with the 3 properties I'm going to talk about now, because I'm not going to go into the numbers in too much detail, but I've assumed 100% borrowing, and I've compared this Christchurch property with an Auckland investment, and actually it's the same one I used on that webinar for a 785, I think we did purchase price, and also then a bit of a different one. So I've done one for a Grants Road house in Timaru. So we're going to talk a bit more about Timaru later. And the purchase price on that for a house is $549, 100% borrowing. You can use a 20% deposit with equity, but no cash deposit. Interest rate of 2.25 for the first few years.
I thought you weren't going to get into the numbers.
Oh, this is me not getting into the numbers. Interest-only mortgages and rents and all the normal expenses. Now, in order of growth, Auckland is the highest at 814. Because, of course, it's a higher asset price and a higher capital growth rate, 6% we generally use. Christchurch second at 520, Grants Road third at 440. Now, Grants Road, I've used the same growth rate as Christchurch, 5%, but we're going to talk more about that later. But remember, the reason it's third here is because it's a lower entry-level price by 100 odd grand. Now, the really interesting number is the return on investment. Auckland's first at 503%. Grants Road is second at 374%, and Christchurch is third at only 253%. Now, the reason that Christchurch performs so poorly is because when we factor all those things in, like interest rates going up, the increasing rent over time, increasing costs on your expenses, Christchurch is negatively geared by about $72,000 over 15 years, which is quite significant when you look at the overall cash flow of Timaru and Auckland, which both work out to be positive over that 15-year period if you accumulate your income on the good years and use that to pay for the negative and the shortfall years. So a really, really interesting result. Christchurch, if you want to have that medium growth, you're going to have to pay so much more money to hold it. And frankly, I just don't think it's worth it.
And this is because prices have increased at so much a faster rate than rents in this case. So while we might expect that it could still have good growth because we still think it's undervalued, it makes it tougher from a rental standpoint. So that's why we need to look at both sides of this. Now you might say to me, Ed, but Christchurch, is it still undervalued? Yes. I still believe it's undervalued by about 15 to 18%, depending on which month you look at. But so is the rest of Canterbury. So you might say to me, well, what else are we going to invest in? And I think two of the things we've kind of already given the game away on. First of all, Auckland, we're big fans of because a lot of the investors that we're sitting down with now are saying, well, if that's what it's going to cost me, if I'm going to have to put in 60 grand in order to hold this Christchurch property over the next 15 years, why don't I just buy in Auckland? And to that, we're kind of nodding our heads and saying, yes, that probably makes a lot of sense. The other thing to do that you could potentially do is look further afield than Christchurch. So yes, Christchurch is undervalued, so is the rest of Canterbury by about the same 15 to 18%. And one place that I'm looking at and getting quite excited about at the moment is Timaru. And the reason behind that is it's about 14.1% undervalued by the same methodology we would use to analyse Christchurch or Rolleston or some of those other areas that we often talk about on the show. And the key thing that I want to point out is that Timaru has actually had higher growth historically since January 2000 than Hamilton.
That is amazing. And it's funny because someone mentioned Timaru to me and I might have even been Ed. And I did what I often do and I tell him, it's a small region. It's not going to get that good crowd. And then Ed will go away and do some research and come in with such a smug look on his face and prove me wrong. When he said 8%, I didn't believe him. I made him get the data and show me to ensure he wasn't manipulating the numbers. It's way better than Christchurch. It's almost Auckland numbers. It's outrageous.
So it has historically been not quite the 8% you mentioned, but 7.6% over that time, comparing to 7.3% in Hamilton over that time. And so while there are certainly reasons, and we've talked about them a lot, why you might invest in larger cities like in Auckland, like a Hamilton, like a Tauranga, we also need to recognise that there are times when we can break our own rules and decide to invest elsewhere if it really makes sense. So in this case, we're looking at a place like Timaru, which has a significantly better gross yield and historically has had similar growth or capital growth to some of those other areas. The other reason why we would look at this in this specific instance is because it's still undervalued, 14.1%, still one of the most undervalued regions around or districts around, and that's why we might have the confidence. Now, I was actually talking to an investor, probably a long-time listener of the Property Academy podcast, given that they were so hot on Rolleston. They said to me, well, Rolleston's where it's at the moment. Just for anybody new to the show, remember Rolleston is a small town, about 40,000 people, 15 to 20 minutes outside of Christchurch, which has had extraordinary growth. And to which I said, well, yes, I wish I'd bought a property there 12 months ago when I had the opportunity. I should have begged, borrowed and stealed to be able to buy that one because it was $525, I think, for a 4-bedroom. It might have even been a 2-bathroom house. Should have bought it, but I didn't because I was stupid and didn't take my own advice. And I'd say, well, now, same thing has happened as in Christchurch where property prices have increased, rents haven't. There was one property there that I know sold recently, 4-bed, for $765K. That property would have sold for $550 12 months ago. And so we all must recognise that markets change. And perhaps I think a lot of people probably have missed the boat in Christchurch because it's not going to be possible to purchase there with a decent rent at some prices that developers are charging. There will still be deals around, like don't get me wrong, but they're not as plentiful. You're going to have to look harder and you're going to have to really work for them.
And I think that's a good message. Don't just rush out and buy any property for the sake of investing. This is a long-term game. It could be 10 to 20 years, depending on what your situation is. So if you rush and buy out the first property because there's only one property in Rolleston and you overpay, or you buy a townhouse that really is kind of overpriced based on what it would look like compared to another investment elsewhere, you're going to end up with something that will later be a lemon and be a cash flow drain for you. And that's going to seriously hinder your ability to grow your portfolio. So it's really important you get it right. By the way, I've just changed the return on investment calculator and you can do it yourself. I've made Grants Road in Timaru 6% to see what the return on investment. It now jumps up to almost Auckland level of 478. And the growth, the inflation adjusted capital growth is 570 compared to the Christchurch 520. So it is really interesting.
Yeah, but I think you'd be pretty hard set to feel confident putting a 6% in there for there.
I just wanted to see.
I know you did. Now, just what I want to say, because I know that there are probably a lot of people listening to the show who currently have properties in Christchurch either under contract or under construction, and they say, oh my gosh, what have I done? Look, the key thing here is about anybody purchasing new properties or adding to their portfolios within Christchurch, because this is all about the purchase price you pay relative to the rent.
Yes.
The issue is the size of the mortgage relative to the rent. So you could have bought a property 12 months ago. If it's still under construction, remember, you paid 12 months ago prices. So when that property is finished, if you're okay with what their end mortgage is going to be, if those numbers made sense when you first bought it, the numbers are still going to make sense. This is about if you're adding to your portfolio and purchasing at these higher rates, because again, pretty similar properties, 200K difference, an increase of about half the house price or 60% of the house price in a very short space of time. So it's changing the numbers. And again, the key message for me to everybody listening to the show is that windows of opportunity are not open forever. You've got to take them while they're there. And then once they appear to be closing or gone, you need to adapt your strategy. Now, what are the two things we need to see in Christchurch for us to think, hey, this is really competitive? We either need to see a really good price from purchasing off, if you're purchasing existing properties, purchasing off a homeowner. If you're purchasing off developers and going down the new build route, then you are definitely going to be wanting a very, very sharp price, sharper than what we've talked about today on the show. Or we're going to need to see some of those rents increase so that the yields aren't so disparate. They've got to have to be much better yields than what we're currently seeing for them to be really competitive. So probably to answer the question, have you missed the boat in Christchurch? Some people may have missed the boat. The key thing is that if Christchurch isn't stacking up, that you invest somewhere else where there is opportunity right now.
And make sure you know your numbers. Look at the last webinar. It was awesome. Download the return on investment calculator, or if you want to get help with this, that's something we can help with. But make sure one way or another you're actually dissecting the numbers to make sure you're not going to buy something that's cash flow burden when those interest rates go up, because that's not an investment property plan.
Fantastic. Let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. Really helps us get the message out to more people. And remember, if you want to download this ROI spreadsheet, links down there in the show notes. Producer David will remind me to pop that in there, and you can download, play around them with that yourself. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
Adrian Nicholl.
And we'll be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most of the New Zealand property market. Until next time.